Hello everyone. Today we are going to talk about impact of margin trading on the volatility of stock market. The presentation is going to be 5 parts. The first introduction. What is a margin trading? Margin trading, also known as a security credit transaction, refers to the act of providing collateral to a security company qualified for margin financing and security lending, borrowing funds to buy security or borrow security and selling. Now let's see why margin trading should be carried out in China. According to the development route of the security market in the developed countries such as the United States, the two-way market is the trend in the future security market. And the margin trading business plays an important role in the development of two-way market. Not only that, according to foreign countries' scholars' research results, margin trading business has 4 major functions: price discovery, market stabilization, liquidity provision, and risk management. These may be the main reasons for why China needs to develop the margin trading.
On March 31st, 2010, the margin trading was launched in the Chinese stock market. Then it was sought after by investors. Until now, the number of underlying securities has reached 963, and the margin trading and short selling balance has reached nearly 1 trillion yuan. However, when Shanghai and Shenzhen exchanges enlarged the amount of the underlying stocks of margin trading, the stock index experienced a sharp rise in 2014 and a plunge in 2015. Consequently, the market stabilization function and liquidity enhancement function of margin trading and short selling have been questioned seriously. In order to obtain a complete and credible conclusion, our project attempts to study the reciprocal effect of the margin trading, short selling, and the stock price volatility.
The third part is the deficiencies. The first deficiency is because of the small number of margin samples. As we know, the margin trading started in China in 2010, which means the number of related transactions is relatively small and the impact on the market is little. So the small number of samples domestic scholars research is incomplete. Then the assumption in models holding other variables in constant has certain limitation. Except the impact of the margin trading, the volatility of the stock market is also under the influence of the overall situation of international stock market. Like the outbreak of the financial crisis that will increase volatility of the stock. On the other hand, microeconomic environment will also affect the stock market volatility, like the growth rate of the supply of goods and long or short-term interest rate. Anyway, all of this will cause some error when analyzing data.
There are several points help our project do better. First, previous scholars usually choose between instant research and time series analysis. One focuses on the impact at specific time while the other analyzes the whole horizon. As they will lead to different conclusions, our project will use the time series analysis to study the impact of marginal trading at any moment. Our project distinguishes the role of financing and security lending and discuss the impact of these two respectively. Instead of using financing balance and security lending balance, we will calculate the financing ratio and security ratio as variables to exclude the impact of market trades. Thirdly, we model all individual stocks of marginal trading in addition to the analysis on the market level. For example, we model the stock index volatility through Gauge model and analyze the relationship between variables through VAR model. After that, we also use individual stock as explanatory variables to make further statistic analysis.
In the process of studying the impact of margin trading on the volatility of the stock index, we want to study both on the market level and the individual stock level. On both two levels, we will use Gauge model and the VAR model. On the individual stock level, in addition to these two models, we also want to find out the impact of the characteristics of individual stocks on the stock index volatility. About the result, we expected that the margin trading business will inhibit the stock market volatility because the original purpose is to provide investors with a risk hedging tool. But if only with margin financing, investors can only express their future market expectations by selling off their existing stocks, and this further increases the spot market volatility possibilities. With the margin trading business, investors can add financing and margin lending to their own portfolios to hedge their portfolio risks and facilitate the discovery of a balanced market price. Therefore, we expected that the margin trading business will inhibit the stock market volatility. That's all. Thank you.